Hello, welcome back to another video on how to become financially independent or how to secure yourself financially. So this video, I'm gonna make a quick recap of this beginner guide to financial statement that after all, they show you the money. And you have four types of financial statement: balance sheet, income statement, cash flow, and statement of the shareholders, where the first show what a company owns and what it owes at a fixed point in time. It is a snapshot of the company assets, liabilities, and shareholders equity. The income statement show how much money a company made and spent over a period of time. So you can think of this as a set of stairs that you start at the top, and one step you go down, you make a deduction associated with that revenue. And at the bottom of the stair, you see if a company is profitable or not. And then I look at the cash flow statement, where reports the cash the in the company it reports the company inflow and outflow of cash. And this is something important because company need to have cash on hands. It reuses information from the balance sheet and the income statement, and the bottom line of this cash flow statement shows the net increase or decrease in cash over a period of time. Generally, this is divided by three main operations. So the cash flow, this cash flow statement review the cash flow from one of these activities. The operations, where what it does is conciliate with the total amount of cash that was used with the net income. Okay, so it uses the information from the net income and conciliate with the total amount of cash that was used or perceived from operating activities. And most common operating activities can be broken down into operating assets and operating liabilities, where operating assets, again, the most common of them are accounts receivable, inventory, property, plant, and equipment, intangible assets such as patent, trademark, copyright, goodwill, customer relationship, trade secrets, prepay expense, expense that a company incur for good and service that has been that will be received in a period of time, such as marketing, rent, premium insurance like medical for health coverage, home, vehicle, liability, disability, life in the event of the policyholder's death, long-term care such as nurse healthcare or home healthcare. Another common operating assets are investment in affiliate like limited partnerships, joint ventures, equity investment, associates. And then I look at the cash and cash equivalent, which is another common operating assets, such as money market funds, which is these money markets involved in the purchase and sale of very large volume of very short-term financial instrument. So the whole idea is to get liquidity, fast liquidity, such as bank acceptance, very short-term debt issued by banks, as a certificate of deposit, so short-term or saving certificate with short-term maturities. The commercial papers, these risky and unsecure corporate debt, repo, which are very short-term security, government security, and U.S. Treasury bill, which is very short-term debt issued by governments. And then I look at the most common operating liabilities, such as accounts payable, accrued expense, deferred revenue, short-term borrowing, income taxes payable, notes payable, and warranty obligations. So the cash flow, what it does is to analyze the net income and conciliate with the total amount of cash that was used for any of these activities that I mentioned before. And of course, I just mentioned the most common. So this is the first part of the cash flow statement, the operating activities. The second is, or before going to the second part, the way it does this, okay, is by see the net income. So the way it analyzes and adjusts is by looking at the net income from the income statement and conciliating with the non-cash items or items that affect the income statement without any cash involved, such as stock-based compensation, something that I'm going to talk about later in this video, amortization or depreciation, and also it conciliates the total amount of cash that was used or perceived from other operating activities. In the second part, okay, now look at the investing activities, which generally involve the purchase or sale of long-term assets, such as property, plant, and equipment, intangible assets, patents, copyright, trademarks, goodwill, customer loyalty as well, investment, installment loans, or in this case, leaseholds improvement, let me take a look at here the long-term assets examples. Long-term assets examples here. Okay. Natural resource. This is more for companies, of course, or even from individuals, right? Like water or food. When you are in a place where everything is collapsing, or it is very, very hard to access that kind of stuff. Okay, so natural resource, leasehold improvement. Okay, so this generally involves this kind of activity, the investing activities. Okay, leasehold improvement made to a lease property, such as renovations, alterations, or additions to better suit the company needs. And the third part of the cash flow statement is the financing activities. So this section, okay, these financing activities, Investor Peter mentioned that focus on how a company raises funds from investors or creditors and pays back directly or pays back through capital markets. This involves the company's liabilities This involves the company long-term liabilities and equity, which primarily involve is raising funds from investors or creditors, repaying debt, and distribute dividends. So most common example here in financing activities are issuing equity. So a company sell common stocks. For example, what happened in an initial public offering, this IPO, this is what happened. Okay. The IPO, issuing debt. So a company wants to raise funds by issuing some financial debt instruments such as debentures, mid or long-term, short and mid-term debt instruments, notes payable, bonds, repaying debt, obtaining loans. It's another example. Repurchasing stocks, payment of dividends, leasing. Very, very important, because I will argue that this is one of the backbones or one of the pillars of the financing activity, leasing. Okay, so from most common people or people that even don't have a property or don't have a company, leasing is one good example of that. Leasing. What leasing does it mean? Well, this is an agreement between the company and another company, or multiple companies, to so it's an agreement for one company to one or multiple companies, so they can use a particular assets, equipment, vehicle, building, without taking ownership of them. Leasing. So a common example of that is rent. So anytime you go out and rent some place, that's a financing activity for the that's a financing activity for the landlord. Okay, and of course it represents is a liability to you. So it's important to recognize this type of activity, especially in your daily life, so you can now see and have more and more perspective of what's going on, at least in the financial aspect. And with that, okay, most of the time, so investors look at the financing activities in the cash flow statement to see how often a company is raising funds and where this source or where this money are coming from. Because if a company, if the vast majority of the cash flow company comes from operating activities, that's a good sign of a good investment. However, if a company is constantly raising funds through taking out of debt or issuing stocks, that might be not a good idea or not a good sign to invest in this company. So, all right. Again, those are metrics. Those are metrics that you can use for that. And then I look at read the footnotes, which are packed with information such as accounting policy and practice, where company need to disclose that so investors can see what accounting practice and how this company has been adhered to this, whether it's the GAAP, the general accepted accounting principles, okay, which is a set of rules by that U.S. company should follow, okay. Or the International Federal Reporting Standards, which is a set of guidelines for financial statement to make them consistent, transparent, and easily comparable around the globe. Now, the next uh, highlight from the footnote is the income taxes, where here you're going to see is from a more detailed level the deferred taxes or the income taxes, the federal, state, local, foreign taxes, and any other items that affect the tax described, pension plans, and other retirement programs. So this section discusses about that, and also specify the information and the cost. So it informs the assets and the cost of these programs and indicate whether and by how much these plans are over or under funded. So something very important, especially if you're working for a company completely, if you're working for a company that have this pension plan or other retirement programs, okay, yeah, that have this retirement plan and any other retirement programs, to see in a much more detailed way the assets and the cost of these programs, and and if and by how much the plans are overfunded or underfunded. Very, very, very important. So Spain, France, US, Japan has a problem with this pension plans and other retirement programs. Okay, cool. So the other highlight in this read footnote, on the footnote, the other topic at the footnote, besides the significant accounting policy and practice, income taxes, pension plan and other retirement programs, now the stock options, where I'm going to dedicate quite a amount of time here to know more about this. Okay, so stock options. The notes also contain information about stock options. Okay, so what is stock options? So according to Investopedia, okay, so stock options, okay, is a financial instrument that gives the owner, and I want to go over this definition and then do some reverse engineering of what's going on. Okay, a financial instrument that give its owner the right but not the obligation to purchase a given asset at an agreed upon price and a date. So I have the right, if I own this financial instrument, a stock option, I have the right but not the obligation to purchase a given asset at an agreed upon price and date. Okay, so if I hold this financial instrument, this stock option, I have the right but not the obligation to purchase at an agreed upon price and a date. Okay, this is stock option, a financial instrument. And when we talk about financial instruments, so talk me about financial instrument here. Financial instrument, okay, assets that can be traded, or they can also be seen as package of capital that may be traded. Important. So anytime we talk about financial instruments, there are assets that can be traded or also package of capital. Okay, if you remember most common assets, intangible assets, accounts receivables, inventory, property, plant, and equipment, investment in affiliates, which is an asset, cash and cash equivalent, which is another asset. So anything that a company see that has value, it can be traded. Okay, and this is the core of this. So this financial instrument. So these financial instruments are like that. So these are assets. Okay. So these are assets that can be traded. Exactly, assets. Anything that has value that can be traded or also can be seen as package of capital. So money, so cash as well. That may be traded. Alright. So with that definition of financial instruments, which are assets that can be traded or a package of capital that can be traded, so this is a financial instrument that gives the owner the right but not the obligation to purchase a given asset at a given agreed, or to purchase a given asset at an agreed upon price and a date. So in plain English, okay, it's also known as equity options. Equity options give an investor. So for example, if I now ask the ChatGPT about this summarize, okay? So if I ask ChatGPT here and say, hey, you know what? Give a summary of the following text delimited by triple backticks. And here I'm using is the concept that I learned from prompt engineering, okay, where the two principles of prompt engineering is write clear and specific instructions, and there are several tactics like use delimiters to clearly define different inputs in your prompt. Okay, ask for structured data, whether it's JSON or HTML. Check if a condition was satisfied in few shotting, meaning provide a couple examples to the model and let the model figure out let the model do the task. Okay, so give a summary of the following text delimited by triple backticks. Okay, so in this case is this definition of financial instrument. Financial instrument or stock options. The stock option, a financial instrument that give, a financial instrument that give its owner the right but not the obligation, to purchase a given asset at and upon and an agree upon price and date, right? Okay. So this means that the owner has the choice to exercise the options and purchase the assets or let it expire without taking any action. Stock options are commonly used in the stock market as a way to speculate on future price movement or of a particular stock or to hedge against potential losses. And I really love this definition because it describes, according to ChatGPT, very interesting and very important topic here. Speculate. To speculate. To speculate. To speculate. So, in other words, this gives the owner the choice to exercise the options and purchase the assets or let it expire without taking any action. So stock options are commonly used in the stock market as a way to speculate on the future price. But this is now from the trader perspective. Okay? So this is from the trader's perspective. So these are stock options. So stock options give the owner the right but not the obligations to purchase a given asset and a specific date or let it expire without taking any actions. So stock options are commonly used in stock market as a way to speculate on the future price movement, which is part of our human nature. Stock options. So stock options at the footnote in a financial statement, the notes also contain information about stock options. Okay, these assets, these financial instruments that allows the owner to, or that give the option, that give the option to the owner to purchase particular assets at a given price and date or let it expire. And stock options are commonly used in the stock market as a way to speculate on the future price moving of a particular stock It's a way. So this is stock options, because after all, the stock options, which are also known as equity, options, are equity derivatives. Equity derivatives or ownership derivatives. When we talk about equity here, an equity derivative is a financial instrument whose value is based on the equity movement on the underlying assets. And when you talk about equity, okay, what is equity? Or equity definition. The amount of money that will be returned to a company's shareholders if all the assets were liquidated and all the company debt was paid off in the case of liquidation. So this definition comes from the balance sheet. Okay? So this definition comes from the balance sheet. Equity typically referred to as shareholders' equity, exactly, or owner's equity for private health company. Okay, shareholders' equity for public companies, or owner equities for private health, represent the amount of money that will be returned to a company shareholder if all the assets were liquidated and all its liabilities was paid off. In addition, the shareholders' equity can represent a book of value of a company. Equity can sometimes be offered as payment in kind. It also represents the pro rata ownership of the company's share. Equity represents the value that will be returned to the company shareholders if all the assets were liquidated and all the company debt were paid off. We can also think of equity as a degree of residual ownership in a firm of assets after subtracting all debt associated with that asset. Equity represents the shareholder's stake in the company, identifying of the company balance sheets. The calculation of equity and home equity is the value of the homeowner property, net of debt. And it's another way to determine equity is used. So let me take a closer look here at the equity.
Equity has several meanings that vary by their context, but in general, each meaning refers to ownership. Equity is one of the
Exactly, but each meaning refers to ownership.
three principal asset classes. The other two are fixed income and cash. Equity also applies to the value of securities in a margin account minus what an investor borrowed from a broker. But in general, equity is the value of a business or property after its debts and liabilities are paid. Think of equity as ownership in any asset after all debts stemming from that asset are paid. A car or a house with no outstanding debt is the owner's equity because she can sell them for cash. Stocks are considered equity as well. Sally's equity can be seen in different examples. She owns 100 shares of stock in ABC Corporation. That stock is her equity in or ownership of ABC. Sally has $75,000 worth of equity in her home. She owes $100,000 on it to the bank, but its current market value is $175,000. On it to the bank, but its current Sally has $75,000 C Corporation. That stock is her equity in or ownership of ABC. Sally has $75,000 worth of equity in her home. She owes $100,000 on it to the bank, but its current market value is $175,000.
So equity, at the end of the day, so equity can be seen as, refers to ownership. But in general, each meaning refers to ownership, equity. So equity refers to ownership, important here. So equity refers to ownership, to put it simple. And when you have an asset, so equity refers to once you deduct all the liabilities of a given asset. For example, if you have a home Okay, so for example, if you have a home, let's say that home worth 50K, and you still own some mortgage around 10,000, meaning that your equity in that house is 40K until you finally pay off the entire debt. So the TLDR it means ownership after you deduct liabilities for that giving asset. Okay, in theory, right? In theory, because now it enters the field of laws and things varies. Things vary a lot. Things vary a lot. Okay, okay, all right, okay. Okay, so that is stock options. Okay, so stock options give the owner, okay, just to use my own words. So stock options give the owners the choice to purchase an asset at a given agreed upon price and date, or can it can or it can let expire that without taking any action. Okay, so stock options are used in the stock options are used in the stock market as a way to speculate on future price movement. As a way to speculate on future price movement on a particular stock, or to hedge against potential loss. So speculate on the future price movement of a particular stock or to hedge against potential losses. Interesting. Interesting. So, after all, stock options are also known as equity options, and equities generally means ownership after you deduct liabilities for that giving asset. Also known as equity options, they give an investor the right but not the obligation to buy and sell a stocks, in this case stock options, to buy and sell a stocks at an agreed upon price and date. And there are two types of options. Okay, puts, which is a bet that the stock will fall, or calls, which is a bet that the stock will rise. Puts and calls, man. Puts and calls, man. Because it has share of stock or stock index as underlying asset, stock options are a form of equity derivatives and may be called equity options. Equity stock options, or ESO, are a type of equity compensation given by the company to some employees or executives that effectively amount to call options. This is the first from listed equity options on stock that trades in the market, as they're restricted to a particular corporation issuing them to their own employees. So options are a type of financial instrument. And if you remember, financial instruments is an asset that has value and can be traded, or it can also be seen as package of capital that also can be traded, known as derivatives. So options are a type of financial instruments known as derivatives. And when you talk about derivatives, okay, a type of financial contract whose value is dependent on the underlying asset group or benchmark. So this means their worth is based on or derived from the value of the underlying security or assets. In the case of stock options, that asset is a share of the company's stock. Exactly. So the option is a contract that creates an agreement between two parties to have the options to sell or buy the stock at some point in the future at a specified price. The price is known as the strike price or exercise. So stock options come in two basic forms: call options and put options. Affords the holders the right but not the obligation to buy the asset at a stated price within a specific time frame or to sell that. So calls are purchase order and puts are selling orders. Interesting. Very, very interesting. So in other words, okay, so these stock options give the owner the options to purchase a given asset at a particular price and date, okay, or at an agreed upon, okay, and at an agreed upon price and date, all right. At an agreed upon price and date. Mhm. At an agreed upon price and date. And stock options are used in the stock market as a way to speculate the future price of a stock or hedge. Or to hedge. What does it mean hedge? Okay, or to hedge against potential losses. Or to hedge. Or to hedge. Okay, or to hedge against potential losses. Or to protect against potential losses. Hedge or protect. Very, very interesting, by the way. Very, very interesting here. Of stock options. So stock options is also known as equity options, and equity, generally speaking, refers to ownership of a given asset minus its liabilities. So there are two types of options: puts, which is bet that a stock will fall, or calls, which is bet that a stock will rise. Okay. And when I go back here to the footnote to highlight some topic of the stock options, the notes also contain information about stock options granted to officers and employees, including the method of accounting for stock-based compensation and the effect of the methods on reported results. Interesting. So including the method of accounting for stock-based compensation Method of accounting for stock-based compensation. Method of accounting for stock-based compensation. What are the accounting methods? Method of accounting. Method of accounting. Method of accounting and the effect of the method on the reported results. So the method of accounting for stock-based compensation and the effect of the methods on reported results. So stock-based option, which is one of the topic at the footnote in a financial statement, where this section is packed with a lot of information relevant, like accounting principles and practice, or significant accounting principle and practice, income taxes, okay, a more detailed overview about deferred income taxes, or income taxes, specific detail about federal, state, local, or foreign pension plans and other retirement programs, where that section discusses about pension plans and any other retirement programs or employment benefit programs, okay, where in there also discuss and you can see specific information about the assets and costs of these programs, and indicate if a company, or indicate if and by how much the plans are under or overfunded. Okay, and the stock options, okay, which is the right to an owner to purchase, is the right but not the obligation to an owner to purchase a given asset at a particular price and time. So stock options, also known as equity options, and when we talk about equity options, equity means, generally speaking, refers to ownership after liabilities has paid off. And you have now two type of options here: puts, which is bet that stock will fall, or calls, which is a bet that stock will rise. Okay, so puts are selling orders, and calls are purchase order or buy orders. So puts is your bet. So it's a bet that stock will fall, or calls, which is a bet that stock will rise. Okay, holy moly. Okay, so that'll be all for this video. Take care. Bye bye.